today, if you talk to a trading desk in Singapore, to a shop owner in South America, or even to a startup in Nigeria, they are all touching the dollar in a way that is pretty new. They do it not through banks, but through apps and protocols. And so today we'll unpack how macro forces from central banks to geopolitics are shaping and being reshaped by programmable money. I'm Joris Delanoue. I'm the co-founder and CEO of Fairmint. At Fairmint, we bring equity on-chain and we make capital formation on-chain by turning cap tables into smart contracts. And today I'm joined by four exceptional thinkers. Jeff, Jean-Marie, and Ilya. Oh, three, sorry, yeah. Blue is not here today, sorry. So I'll let you present yourself. Go ahead, guys.
Sure. Hi, everybody. Good morning. My name is Jeff Park, and I'm the CIO of ProCap, which is a Bitcoin treasury company. RS4 actually just went effective this past weekend, despite a U.S. government shutdown. So it was a big milestone, and lots to do in this space that we're excited about. Before that, I was at Bitwise. I was the head of alpha strategies there. And today, still an advisor at the firm.
Yeah, certainly excited to be on this panel. At LMAX, we run exchanges globally across FX, commodities, metals, and digital assets. We've been in the business for 15 years with the digital pairs and the digital business spinning out around 2018. We're doing something around 30 to 40 billion of volume a day, and I would say maybe 1 or 2 of that on a good day is in digital assets. Our clients are all institutional, banks, market makers, asset managers, crypto native, and I'd say across our client pool, maybe 35% of our clients are doing digital, and we're super keen and super excited to get that number up.
Hi everyone, thank you for joining. I see the room is filling up as you speak, so it's good. My name is Jean-Marie Mognetti. I'm the CEO and co-founder of CoinShares. CoinShares was created in 2014 out of Europe. It is today a company listed in Sweden and moving to NASDAQ in the US in Q1. We're managing $12 billion for our clients, only in digital assets. And we're excited to talk about that today.
All right. So let's dive in, starting with the big picture. We've had inflation spike, rates hike, geopolitical shock over the past few years. And we also seen digital asset reacting faster and super visibly to those events. So here is the first question for you all. Like, how are global macro forces, think like interest rate, inflation, geopolitics, showing up today in the digital assets? Jeff, you want to start?
Yeah, I can kick it off. I think right now we are living in probably one of the most interesting inflection points in macro history. There's a lot of underlying undercurrents that are happening. Some are in motion together, some are in contradiction of each other, but they all have different implications for the role of Bitcoin and crypto for the broader adoption to come. The first thing I think people should be focused on is that there has been a change in monetary policy that was announced, right? We are officially ending QT as of December 1st. This is happening. Many would argue that it actually was a little bit more abrupt than people anticipated that announcement to come, which implies that there may be a little bit more of a funding stress that we're going to navigate in the coming months. The other part that's been intimated is that there likely will be some kind of asset purchases to come. And whether that is going to be additional T-bills or treasuries or other credit duration assets that have implications for risk appetite is an open-ended question, but make no mistake, there is a change happening in the coming months for the role of the Fed and the balance sheet. So that's important. And that has a lot of impacts to how people are thinking about the debasement trade to come and all the things that touches Bitcoin. The other underlying trends that are happening, though, is not just monetary policy. There's a huge industrial policy effort that is taking place in the US as well. And this is predominantly coming from the lens of data centers and the way that people expect AI to play a much broader role in the growth trajectory for these developed countries. When you think about data and energy as the input to a lot of these things that are consumer facing, you also have to remember the commoditization of the energy itself has some implications for the role of assets like Bitcoin or other crypto functions that we expect power to play a role in. So that's another dimension that I think is really interesting, coming from an industrial policy lens that is actually pretty tectonic in the way that we're going to have some global competitive behaviors. And then the third thing I would mention is a fiscal policy front. There's no doubt that the biggest challenges that is happening in this country is due to fiscal challenges in which the generations of people feeling displaced, especially if you're young and educated, has taken hold. And you saw a glimpse of that last week when there was an announcement that the US might consider a 50-year mortgage to advance home ownership, and how much of a universal populist backlash that was across both the right and the left, and especially amongst the young. And so when you think about that fiscal dominance also taking place and the role of what that means for just broadly technology and the way like people think about the role of these assets going forward, like what is a store of value? Is it really going to be my home? Or are there other things that could be useful? These are all kind of open-ended questions that I think Bitcoin is literally at the pin of the center, but there's a lot of other things around it with stablecoins and tokenization and technological advancements that have impacts to all of these verticals.
Absolutely.
So maybe let's evolve on the pin of the center. So Bitcoin is the pin of the center, and what does that mean? So far this year, we've seen about $50 billion of inflow in digital asset ETF globally. 60% of that is on Bitcoin only. So when Jeff talked about Bitcoin being at the pin of the center, it's really visible in the data as well. Of course, Ethereum has been having a good traction this year post-launch. Ripple and Solana have been showing also strength in Europe, probably going to show strength as well in the US post-launch. And it's a very dynamic world. If you look at the 2025 numbers versus 2024, we're already above the net inflow in 2025 than the whole year of 2024. So we're really on a different dynamic, which is evolving through that. And then you have to add all the treasury company, which is ProCap is doing as well, which is adding to this kind of pinnings and narrative around digital asset in general.
And I suppose I'd also add that to your point, from a liquidity and trading perspective, right, we're certainly seeing digital assets influenced and reacting to global macro, no question about it, and there's certainly been a lot to be impacted by. But on the exchange specifically, we certainly see that a lot of the alts have a almost outsized impact when there's a macro trigger, especially when we're risk off, right? And I think we see liquidity dry up on the exchange, we see risk capital kind of take flight to a certain degree. The flip side of that, however, though, is that Bitcoin is increasingly seen as a store of value, as a safe flight asset. And I think for a lot of the folks in this room, I think for folks that have been in this space for a long time, you're somewhat seeing the realization of the value prop, right? The value prop that Bitcoin can be a store of value. And we're seeing that on the exchange, and that's been exciting.
Yeah. On that point, Bitcoin is a store of value. If you look at the company listed on NASDAQ today with 20% of the net asset being composed of Bitcoin, they represent 70% of NASDAQ trading volume. It's just like, fascinating to see how the stats are being influenced by the presence of digital asset on your balance sheet as a store of value or whatever the treasury company want to put it in together.
Yeah, clearly Bitcoin went from liquidity proxy to a genuine macro asset, right? Okay. Let's move to the second part of this panel, from macro to money itself. We kept hearing about de-dollarization, nation willing to move out of the US dollar. And yet, USD stablecoin are dominating global crypto flows. We could say it's a paradox, but at the same time, it's also a genius move from the US to get back in the game. And so here is a question for you. If the world is supposedly de-dollarizing, why do we see USD stablecoin winning? And what does it tell of the next chapter of dollar dominance?
Okay, you want me to take that one? Yeah, I mean, look, I think when you look at stablecoins post the Genius Act, it really established the, I think, global legitimacy for the asset. Right? And if you look at emerging markets specifically, we're seeing real use cases. We're seeing payments being processed, we're seeing remittances, we're seeing actual flows, and that's translating into volume, right? That volume is now on par or eclipsing kind of the more traditional rails like the PayPals and the Western Unions, and it's even brushing up against the global leaders like Visa and MasterCard. And especially when you add tokenization to that equation, because arguably, and we'll hear many panels today on tokenization, you need a stable, secure infrastructure and rails for that. And I think above all, right, that's ultimately going to create this self-enforcing requirement for dollar-backed stables, right? Because at the end of the day, they are pegged to the dollar, and that is by far the leading kind of driver of it. So I think, talk of de-dollarization, yeah, sure, it's somewhat happening, but I think the volumes and the scale and the demand for stable coins being dollar-backed is going to affect that decision. And I don't know that there's going to be much of a competitive attribute from other coins or other assets.
So if you step back a little bit, so stablecoin was created in 2015, 2016. It was an obscure experiment from effectively the Bitfinex team struggling to move money around because the bank were not working in their favor and blocking wire in all directions. Say, okay, how do we settle with our counterparty? Yeah. So stablecoin has a very difficult, effectively, adoption in the West in general because for us it's a champagne problem. You have a SoFi app, you have a Robinhood app, you have any kind of app in the West. It works very well to share a bill at the restaurant or anything. Now, you wake up in Argentina one morning and the country devalue your money, it's a different story. So the adoption has really been emerging market, developing market first, and coming to the West after. And so it was not really perceived as a real problem. And the Genius Act was really kind of the effectively penny drop moment where all of a sudden all the banks were like, oh, wait a second, like there's a stable coin, but this stable coin also needs a blockchain. It does not exist on its own. And then you see all this inflow coming into Ethereum and the Circle IPO success was really kind of the illustration of that. Say, oh, we need to back a winner of that stuff. And I think last night was the first time where you get effectively bank trading together with stablecoin on different ledger between DBS and JP Morgan. And so you can see how this is really transforming from a tool for the developing and emerging country, which are bypassing the banking layer effectively because they need stability, to an infrastructure play at scale for the Western world and the banking industry. The M&A activity on stablecoin company has been very, very intense. Started with Stripe acquiring Bridge a couple of months ago, 18 months ago now. Coinbase was about to buy BVNK last night. I think the deal didn't went through, but there is a number of deals which are happening right now around stablecoin, and Circle was just a kind of super poster child IPO of that cycle. So all that together is showing how stablecoin are really kind of transforming the world. As a reminder, Tether is probably the 12th biggest treasury holder for the US government now. Not a number which is a small number if you think where they started in 2016. And if you look at Trump administration and post-Trump administration, these players are now welcome in the US. So there was a famous quote from 1971, which is "dollar is our money, but the world problem." And that's really what's happening now. The stablecoin is really a vector for the US dollar to take over what's happening now.
Yeah, this reminds me of like when people used to talk about tokenization, and it really mattered what they were talking about because tokenization was like a catch-all phrase for either like a securitized token or tokenized securities, and you really had to know what you were talking about to even engage a conversation. Stablecoin right now is exactly in the same problem and opportunity set, which is that there's two sides to the stablecoin story. One is, I think, an internal domestic money plumbing story, and then there's the international export, the dollar hegemony story, and they're different. And so on the side of like the domestic side, when you see the story of like the launch of USAT, right, Tether launching a Genius Act compliant stablecoin here in this country, that's a very different product than USDT that was described earlier from 2015 era of like market making. Those are different utilities of what stablecoins are meant to bring. And there's opportunities in both. So when you see things that are happening with like Circle and Stripe and Tempo, all the things as a fintech for payment processing happening here in this country, that's going to change, I think, the ways banks generally operate, right? This is actually going to unlock a lot of different opportunities for us as domestic consumers, as American citizens, in the ways that I think is topical to even the story that we saw last week with MasterCard and Visa finally settling their 20-plus year lawsuit. Like, I don't think this is actually a coincidence at all that they are finally settling this after decades of not doing anything, because guess what? Stablecoin, they're coming for MasterCard and Visa. They're not going to have to sue each other. They have bigger problems. And then the point about dollar hegemony, the export problem or the export opportunity. This is why I think stablecoin was the first thing that legislatively Congress has wanted to adopt as a crypto agenda, because we all know in the end, anything that's ever going to happen from a technological improvement is going to have some aspects of the government involved, especially when it touches things like financial services. And I'd share the most interesting thing I noticed last week was Governor Myron was here in New York actually and had an opportunity to talk about the role of stablecoins here in the US. And something he said like kind of struck a nerve with me, which is this idea of exporting dollars, because and we know emerging market consumers, they really want dollars, but they don't necessarily need the yield, right? Think about this. We as Americans will never not want yield on a money market fund, right? Okay, I'm due that 3.5%. I want that 3.5%. But if you're in like Kazakhstan or whatever, all you want is just the dollar. I might not want the 3.5%. And that spread is the arbitrage that is being possible with exporting US stablecoins in a format that is directly reaching the consumers who want to save in dollars. And I think in the end, that's actually going to be the big counterforce to dollar adoption and a way to think about the deficit problem and how to think about having dollars more pervasively in the markets. That is actually going to be a stronger network effect through the lens of that channel that hadn't existed before. And that's something I think everyone in this room probably is going to be caring about for a long time to come.
A very quick question that we didn't discuss already, but based on what you just said, Jeff, like, could you see another currency like the yuan, like the euro, or even any gold-backed token or asset challenging the dollar?
So here's the thing. The Genius Act is very clear about how it applies for compliance, right? It has to have one-to-one backing of dollar-based assets, right? It has to be T-bills and money and cash equivalent type things, so it has to be dollar-based. Now, to your point, I think there are some international players that are trying to bridge the gap between consumer preferences of maybe wanting non-dollarized risks as defining the unit of account through still a dollar stablecoin. One version of this we saw, I think, I believe it was Kazakhstan that is now trying to launch a stablecoin that is backed by gold, right? So the reserve is gold, but the unit of account is dollars. That is not Genius Act compliant. And so there are going to be elements of this conversation as to how the US will, I think, still want the end game being they want people to buy our T-bills, right? Like we need to obviously increase the velocity of T-bill distribution for liquidity transformation, which is exactly what the next phase of QE is going to look like. And we need more buyers of short-term funding. And this is a way to enact that. And for that reason, I do think in the near future, it probably is going to be dollar-centric.
Just to quickly double click on that, right? I think the political aspect is also kind of interesting, right? Because if you think about, you mentioned renminbi, right? I am certain the Chinese would love to see a global trading order denominated in renminbi. And even if you back up and you say, what is the biggest strength of the U.S. in our economy in America, right? And you can point to capital markets, you can point to democracy, you can point to institutions, you'd be right. You can point to the military, you'd be right. But I would submit that one of the biggest assets we have is the U.S. dollar. Yeah. And the fact that the U.S. dollar underpins global trade benefits the U.S. more than anyone else. And I know for a fact that the administration recognizes that. I think part of Genius was a recognition of it, and I am certain that they will protect that.
So it's down to liquidity. It's just like people want liquidity. You don't want a euro stablecoin with von der Leyen making rules every morning about where to go. You want stability and liquidity. So, same thing with renminbi. Not really sure I want that in my portfolio and sleep on it. So the point Jeff was making was that you don't want to go to bed in Argentina, wake up next morning, and your bank account is down 25% because the government make a decision. Stablecoin give you the certainty, and effectively, if the US don't export, military force anymore through this administration, they're definitely exporting the power of the dollar and the stabilization virtue of the dollar. And so if that works very well, you will not see effectively a lot of success out of gold-backed stablecoin, out of euro-backed stablecoin even less. I think the Europeans need to decide first what they want to do with themselves. And then we get all this experiment around synthetic stablecoin and algorithmic stablecoin, which are just fantasy for the time being. And the Genius Act is very clear, and I think it gives a very, very clear blueprint how to scale and to see interoperability as well between different stablecoins.
All right, so we are seeing that the monetary system itself is getting programmable. Liquidity, yield, ownership, everything is starting to live on-chain, on-chain. And we are seeing like tokenized T-bill, you mentioned it, tokenized fund, even equity now getting tokenized. And at Fairmint, we see that. We see private companies, board members coming to us saying, hey, let's turn our assets, our shares into programmable capital. So can you tell us more about how you see tokenization reshaping global liquidity and capital markets?
Yeah, so I think ultimately the US as a nation can decide how they want to think about growing out of its deficits, right? And look, the reality is like the US is very much in the business of running a trade deficit because we're in the business of running a capital account surplus. It's actually that simple. So if you believe that is the path in which we need more capital account surplus to run larger trade deficits as a way to bridge the gap, one way you can run a capital account surplus is to permit more offshore investors to come into dollar assets and US-based assets. And that's what tokenization is. You're ultimately opening up a variety of dollar and US-based financial assets to investors offshore that historically have not had access to entry. So even the idea of some foreigners that want to participate in the wealth creation of the US stock market, which is actually quite challenging, there are so many people, for the same reason they want to save in dollars, they would love to own a piece of Amazon or Facebook, that you and I, we're so lucky that we get to do this every day and have the choice. But there's many people out there who don't. Part of why China has a real estate problem is because the Chinese people know their stock market is actually not an investable asset class. They know that it's been sideways for decades. A lot of Asian countries go through this. So real estate is the only thing that they can actually save in. So now you're giving these people another option. Hey, if you don't like your stock market, come to ours. And tokenization, I think, can open that path for a variety of different US assets, which allows, again, us to run a higher capital account surplus, which by definition we need if we're going to imagine that trade deficit is a part of the social contract that we're underwriting as a global exporter of finance, which I think that is US's superpower as it exists today.
So I completely agree with what Jeff is saying. Nothing to add there. But if you look at Euroclear DTCC were creating in 1970, and that's the start of the electronification of the market. And since then, nothing has changed much. I was talking to a French bank a couple of months ago who was explaining me how they tokenized their first bond issuance. And so they went through the entire stack of what is required to tokenize this bond. And they realized that some people were moving stuff from A to B, not even knowing why they were doing it. Someone told them to do it 10 years ago when they still do it. And so what tokenization is doing here is like basically allowing you to reprogram and to script everything you're doing from an origination to an emission and issuance point of view. Cutting all your costs down massively, cutting your back office and middle office requirements massively, and the simple fact that BlackRock, after a lot of acquisition, is looking at tokenization. It's also a way to improve EBITDA. Yeah. And overall, tokenization, and that's where I would join Jeff, is basically distribution supercharge. It's like how to supercharge distribution capacity of financial institution. If you harness tokenization properly, you end up having capacity to innovate as a financial innovation for the cost of nothing. You don't need to issue a bond for $100 million minimum. You can issue a bond for $10. So all this kind of like addressable market become much, much, much wider than people think. And that's kind of the dawn of that situation we are facing right now. And very few people are just seeing the entire picture because it's just so big that you can't realize it. And just as an illustration, I need to be careful because our banker in the room. Yes. I saw them crippling in. But
see them.
But the first, when we announced we were listing to the US, the first question we had from a very key shareholder is like, are you going to tokenize the stock?
Yeah.
It was like not even a discussion. And so this is part of the expectation. I was like, is there a tokenized version of your stock?
Yeah. Ilya, I'll start with you with the next question. I think we are running short on time. We've talked about macro, about money, about infra. Let's finish with what's next. And if money itself is becoming programmable, if Bitcoin is becoming like the default saving account for millions of people, who now actually sets the macro policy? Is it central banks, markets, or code?
I mean, I think it's all three, right? I think it's always been all three, quite frankly, right? I mean, I would expect that the central bank is finding more competition from other sources, right? But I also think that they've always had other inputs, whether it's politics on one day, whether it's code on another. So I think we are certainly in a world, and we'll continue to face off a world where there will be a hybrid system, right? Central banks will continue steering the fiat economy and the fiat rails. I think markets, to your point, will do what markets do best, which is price discovery. And I think the code aspect of it will fill in the gaps with the immutable aspect, right? The one caveat I would say, though, right, is that code is still subject to the human condition, right? Like you have forks, you have programmable governance, right? So it's still the social aspect and the social biases can still exist, and I think that will also shape into it, and which is frankly why all three play against each other.
I think the first time I sit on a trading desk, my mentor at the time told me, "Don't fight the central bank." That was a kind of conducting journey of his life. Don't fight central bank and how you make a lot of money. Eventually, after 10 years of fighting with me, he became also a Bitcoin maximalist. So I think it changes stack around what is really driving the force, and effectively the story is I don't fight central bank, is don't fight liquidity.
Yeah.
And I think we're at a point where the orders of things as we are used to know it, where central bank were deciding where it goes, and central bank with some kind of independence or not, actually, depending on which central bank you're speaking about, is changing slowly and surely, and pool of capital are relocating some time away from this kind of central bank-driven model.
When we talk about quantitative easing, right, as a term that now we take for granted, I often remind people the reason it's called quantitative easing, we know why it's called easing, we're easing financial conditions, but why is it called quantitative easing? Is it because it's technical? Is it because it's like model-based? No, it's actually called quantitative because they're talking about the quantity of money, right? And when you squint hard enough, you realize most of the monetary policies and frameworks we have are levers of two things. It's some kind of liquidity transformation, and it's some kind of credit transformation. And controlling the risk spectrum across time and that credit element is the job of what a central bank is doing. And by controlling the quantity of money, they try to affect these outcomes. I think about Bitcoin in the construct of thinking about the quality of money, right? When people are gravitated towards the idea of a store of value in Bitcoin, it's because they're talking about that quality aspect. And in that lens, I think the third lever that the Fed can't touch, but now we're seeing elements of it through industrial policy that is being taken place, is actually energy transformation. Because if you can't control just liquidity and just credit in ways to affect monetary outcomes in the way that AI is now going to be a very meaningful component of the labor force in the ways that the Fed absolutely cannot control for, we're going to see the emergence of these three things come together. And I just cannot imagine a more incredibly useful and necessary asset than Bitcoin in the era of energy transformation that is going to be unfolding for monetary value.
We are running out of time. I have a quick question for you guys, a funny one. If you had a magic wand, what would you change? Like one thing in the way digital asset and macro, like global macro, interact?
Regulation. I mean, I can't believe I'm saying this. I've been a salesperson, a trader my whole career, and I grew up in a Dodd-Frank world, but regulation, right? I think it's the single most important unlock for the US and for us at LMAX, especially in the Americas. Patrick Witt last week was speaking in New York. I think some of you guys were there. And he's on the President's Digital Asset Advisory Council. And he was pressed on the passage of clarity or market structure. And he gave a year-end timeline. Now, I'll submit it's probably closer to Q1, but that is without question the biggest unlock. And if I had a magic wand, what I would wish for.
All right, let's wrap it up. So basically, macro used to be about policy. More and more, it's about protocol. I think it's a great thing that we see happening today. Lots of acceleration, like Josh, said it when he made the intro today. A lot changed since a year, the first version of the bridge. So thank you to our brilliant panelists here, and thank you to the TAI and all the team at the TAI for hosting us today.
Thank you, everyone.
Thank you.